Good morning, good afternoon, and good evening. My name is Diana, and I am the head of research and sustainability at the Global Blockchain Business Council. And it's really my pleasure to welcome you today to the GBBC's Virtual Members Forum on progress on institutional adoption of blockchain. This is a bi-weekly webinar showcasing the innovative work of our members around the world. And today we're joined by Morgan McKenney, CEO of Provenance Blockchain. Provenance Blockchain is an open source public blockchain using Cosmos SDK and Tendermint consensus, designed specifically for the financial services industry, and it is already being leveraged by 50 plus leading banks that have transacted over $8 billion in digital assets across lending, marketplaces and exchanges, and payments. Morgan will walk us through how financial services participants are leveraging digital money, digital assets, and blockchain for material business and consumer value across lending, private assets, payments, and other additional emerging use cases. Before we begin, I'm going to introduce Morgan, who is, again, CEO of Provenance Blockchain Foundation, and she leads the expansion of the Provenance blockchain ecosystem in order to enable financial institutions to realize significant business benefits from blockchain. A leader in payments innovation and digital transformation globally, Morgan has spent her career focused on innovation for institutional and consumer clients. Prior to her current role, Morgan served as a special advisor at Center, a consortium to promote trusted use of fiat-backed stablecoins, including USDC, and as a Bain expert advisor in the digital asset space. We welcome your questions from the audience at any point during today's presentation, so please submit them in the Q&A tab at the bottom of your Zoom screen, and we will take them after the presentation. So once again, thank you, Morgan, for joining us, and I'll hand things over to you to begin.
Awesome. Thanks so much, Diana, and thanks to the entire GBBC team. I'm absolutely thrilled to be here. I have immense regard for GBBC members and the amazing work you guys are doing around the world and the quality of the dialogue and collaboration across some very important topics to advance blockchain usage thoughtfully. I was an executive in residence for GBBC as well, and a big fan. So I'm delighted to be here, and hopefully we'll leave plenty of time for questions to make it as relevant for you all. And looking forward, if you hear anything that catalyzes ideas, thoughts, collaboration spaces, at the end of the document, we put our contact details, or feel free to reach out to me on LinkedIn or personally at Morgan McKenney at provenance.io. So it's because it's a big lift to re-architect how financial services works onto blockchain. I call this finance's 1995 moment, when really we can fully re-architect how financial services works. And we'll get into how some of the ways that that's happening today and what's coming soon. So let me kick off the presentation and share my screen. We had the privilege to share an early update on Provenance Blockchain 6 months ago. It's when I was just kicking off, and so lots has happened since then. And so we'll really get into what use cases are live today at scale, and what's the business value being delivered, and what are some of the insights of how blockchain is delivering that, and then where are some future opportunities that we're working on. But I think the big focus and the reason why I took this job is I believe we're finally at a stage, and one thing in my background Diana didn't mention is I'm a recovering banker. I was at Citi for 18 years, amazing years around the world, a decade abroad, mainly in the institutional space, but also in consumer, and always trying to help innovate for customers using technology. That's been the theme of my career. I'm a comp sci major from way back in the day, and a blockchain practitioner, having implemented blockchain twice at Citi with the team there, once with NASDAQ in 2016 and once with Alibaba and Ant in 2020. So I've actually done the heavy lift, spent a year and a half of my life for each of those projects, working to try and implement blockchain, and it is hard. But I think we've advanced, and the reason why I took this job and the reason why I left Citi is really we're at a place where digital assets have matured. People understand what NFTs are. Digital money has matured. We have stablecoin and people own crypto. Digital identity is still weak, but a lot of folks focusing on that. Digital security, you have hardware wallets, you have important custody solutions of these digital assets, and you have networks and chains that people have heard about that continue to mature and evolve, which are the new rails. And so I had planned on staying in advisory roles at Bain and at Center for 2022. So I had felt it was too early to pick a winner of somebody that could actually scale adoption single-handedly, collaborating with the ecosystem. And that was until I found out about Provenance. And so I was, in my plan of advising for this year and heard about Provenance. And as I started looking into it, it has an amazing set of assets to help catalyze adoption. And I'll get into those catalysts because it was specifically purpose-built for financial services. And by that, we mean institutional and regulated finance. And by that, we mean help existing financial services participants basically operate their business better on blockchain. So we are not trying to blow up the financial system, right? We are not pretending that banks don't exist. We are trying to support banks in their evolution in terms of how they serve their customers, reducing significant costs, increasing the ability to create new products, increasing access to those products, and really having a lot more transparency and speed in the whole asset life cycle. So there's a number of different benefits that are being realized today. And I think important to mention, we're built on Cosmos SDK. And for those that are not familiar with the Cosmos ecosystem, that's called the Internet of Blockchains, because each blockchain in the ecosystem is purpose-built for their use case. So we are purpose-built for financial services, for proof of stake, for high throughput. We have data control. So personally identifiable information, the thing that finance runs on, all the information about customer loans, et cetera, sits off chain in a contract execution environment, encrypted object store off chain. But what's hashed on chain is a digital fingerprint, basically, that ensures that that data hasn't changed. And it confirms that actually that transaction obviously happened, right, on an immutable ledger. And basically what this creates is the ability to bilaterally transact a financial asset instantly in real time, being agnostic to your counterparty. So meaning I don't have to know you from Adam, you don't have to know me. We can meet on blockchain and basically transact that asset with no intermediation. And that is really disruptive and transformational for financial services. There's a range of things around KYC and AML that's still early days, I would say, in blockchain land generally. But an idea is you can add a credential, an identity credential, meaning you are an accredited investor, you can buy private funds, and you can passport that credential. So again, there will be a range of ways you can use blockchain around KYC and AML, which is obviously a key part of the financial services flow. The ecosystem is live, as Diana mentioned. There's over 50 financial institutions that have participated. That includes many banks. We have what's called USDF Consortium, which are a group of banks that are committed to bank minted tokenized deposits. We have a range of asset buyers, credit unions that are buying these lending assets that are originated on chain. We have Hamilton Lane just announced last week that they are putting the first 1940 Act fund, so a registered investment fund, on Provenance using Figure's digital fund services capabilities. And what that does is it lowers the minimums for their investors. It makes that issuance process much more efficient, the ownership record more clear and streamlined, and offers secondary liquidity opportunities in the future. We have about 70 validators. These are some of the very well-known names as well. And a number of partners. Our utility token is Hash. For instance, Anchorage Digital is a custodian of Hash. They allow staking of Hash, which is important for governance. Piper Sandler is helping us sell USDF in terms of getting more banks adopted. And so we have a neat set of developers. Also, Storyline, as an example in the middle there, is helping writers get paid. It's a huge industry. It's very contractually driven, but actually enforcing that contract of as and when projects develop and go through the maturation cycle, getting writers paid and helping that And we have a new hash owner, Nova Wolf, that's putting distressed assets on chain as an example. So, and a lot of smart VCs that own hash and believe in the future that, blockchain will rewrite financial services. So if we think about, again, as we think about adoption, one of the things is it's a different way of thinking about the world, right? Most people in finance, many of you on the phone probably come out of finance, you think about your asset class and then your function, right? So I'm in mortgages and my function is credit. And the thing about blockchain is it's the new digital factory of finance. It's the new assembly line of how assets are originated, how they're serviced, financed, traded, and securitized. And we don't think about financial services in that life cycle, but blockchain enables, once you natively issue a financial asset on chain, everything else downstream becomes quite improved. And so if we think about, for instance, Hamilton Lane, this 40 Act funds, that's going to broaden investor access. They drop the minimum, right, materially. And then as you streamline that primary issuance, you make it easier. So we have 500 companies that use figure equity solutions. These are young companies, Series A, B, C, D, E. And basically, it makes it a lot easier for those companies to issue the equity in their company because it's highly digitized, the subscription process, all the documents by the investors to meet Reg D requirements, et cetera. And then you think about holding and servicing that asset, how you do payments out as dividend payments, capital calls in, loan repayments, et cetera. Trading, you create there's an ATS, Figure has an ATS that allows trading of blockchain native securities. And basically that means digital security, folks creating those digital securities can bring it, sign an agreement with the broker dealer, but put those on, a limit order book as an example to create more liquidity, making, previously illiquid assets liquid. So it's important to think about this new digital asset lifecycle and starting out digital, right? Analog doesn't scale. If you have a piece of paper or it's a digital twin, we don't believe in digital twinning. We believe there's one version and it's the natively issued on chain version of the asset. And so now if we get into what's catalyzing adoption, and so why do we have $10 billion transacted on chain today? And the use cases that are live have been pioneered by Figure. And the story behind this, and as a disruptive innovator, I am really impressed, and this was before my time, Mike Cagney, who founded SoFi, which is a consumer credit firm in the US, and his wife, June Oh, who actually managed the product and engineering teams, built out Provenance Chain, and it was permissioned. It started off permissioned on Hyperledger. We became proudly public on Cosmos in May of last year. And that was an important pivot. And I wouldn't have taken this role if I was running a permission chain. I really believe that, the platforms of today are the most valuable companies in the world. And blockchain and decentralized platforms really are the next platform, next gen platform, and it needs to be open. Platforms today bring together buyers and sellers successfully and are open innovation platforms, most of them. And so if we have a permission chain, it's just recreating the intermediation that happens in financial services today. It's just harder to implement because blockchain is not easy to implement. So public means we're crowdsourcing the future of finance. That means a range of participants, diverse of thought, backgrounds can build new products and capabilities in a way that was never conceivable, right? In an age of intermediated finance that is really owned and controlled by large players. So this openness is very important. The interoperability is very important. Cosmos talks to, chains within Cosmos ecosystem can talk to each other. Most financial services today in old school land are very stovepipe, right? Specific asset, specific ecosystem. And then the blockchains of today, many of them are sprawling walled gardens. You have to kind of conform to how the structure of that blockchain works. So we think interoperability across chains, there won't be one chain to rule them all in general, because things need to be optimized for different use cases. And financial services is so big. Obviously, we clearly plan on being a leader, but there are so many asset classes that each take quite specific subject matter expertise to really transform. So I think this interoperability will be quite important to create better platforms of tomorrow. So Figure, what's live today? Figure has focused in 3 highly intermediated verticals. So lending, residential lending, mortgages, and home equity lines of credit. So Figure has originated $4 billion of HELOCs already on chain. And basically what that, it's a very in-demand product because house prices has risen significantly. HELOCs provide an opportunity for people to take some of that out of their house, but not have to refinance their previously low mortgage rate that they've had, right? Because mortgage rates have increased. So what that means is when you originate the HELOC on chain, you don't have to keep reopening that credit file. So basically all of that detail about the origination, again, sits off chain, but the digital fingerprint is there. And the person who wants to buy a set of loans, a set of HELOCs, can digitally see that, see the loans, decide and see the repayment status, the real-time repayment status of those loans when you would get that 30 days later, let's say, in the old world of securitization. And basically, sort by FICO score, sort by postcode, sort by zip code, et cetera. So it makes the securitization, which is the offlay of risk, right? So Figure doesn't have a large balance sheet. It's a fintech. It needs to originate to distribute. So this hopefully gives folks an illustration of how you have real-time information about the performance of the loans, and you don't have to ship documents to go through the loan agreements physically, right, to a big conference room and go through them and make sure it matches the Excel file that somebody has of the loans available. So it's highly digitized, but it's because you started off digitally. Then their second vertical is markets. And really this is in the private asset space. So there's over 500 companies using Figure equity solutions. And not only are they issuing basically that equity interest, but then the cap table can be on chain and they can offer secondary liquidity, let's say to their employees. So Figure has run basically secondary trading for a period of time where people can come in and buy Figure private market securities. Employees can sell it, and it's, again, makes a previously quite a liquid asset more liquid, which brings value, brings other buyers, offers the opportunity, obviously, for selling the asset. Digital fund services we're really excited about. This is Apollo is launching imminently a digital asset fund, flagship fund. They're a $600 billion alternative asset manager. They are issuing basically a digital channel that issues the LP interest natively on chain and keeps the cap table on chain. And then again, Apollo can offer secondary trading, again, let's say quarterly in a couple of years. That gives people an opportunity to come into the fund or leave the fund, which attracts more investors for them ultimately, because they don't have to pick only investors that can hold the assets for 10 years, let's say, right? And not that many people can lock up their capital for 10 years. So we talked about Hamilton Lane. There's another very large asset manager getting announced early next week, which we're really excited about. And so there's, 700 plus accredited investors. These are in high net worth and institutional investors that have bought these funds. And this will continue to grow. So blockchain, a killer app, is in the private asset space because these are high friction assets. They're highly illiquid, non-price discoverable, non-tradable, and operationally intensive to issue and manage. And then last is payments. I mean, we still have a highly intermediated payments market, especially if you think about credit cards and interchange, right? You have the issuer of the card, you have the merchant processor of the card, you have MasterCard and Visa in the middle. That's highly intermediated payment. And, the US is one of the few markets that doesn't really have a whole set, across the board used basically real-time bank payments. And so we start getting into tokenized deposits where, you can help your business customer as a bank accept money in real time, get funds in real time, not 3 days later like you do with a credit card, and avoid paying 150 basis points for that transaction. So there's some neat use cases that Figure has incubated and is really trying to crowd in adoption in these spaces and lead the way. The last two things to highlight on this page, again, we think this is first and only. So this thing called digital asset registry technologies. What this does is, let's say in the case of a mortgage, right? You issue the e-note, the mortgage, the electronic version of the mortgage natively on chain, on Provenance. And that's happened to the tune of billions of dollars. And then, somebody else takes on that loan. How many of you guys have had your mortgage, the original person that gave you the mortgage, that gets sold off? So what DART does is it transfers the lien ownership associated with the loan, right? So my mortgage provider sells the loan to somebody else. That somebody else needs recourse, right? They need to perfect their collateral, their interest, and they need to have a lien on the house that they're lending, that they're offering the lending for. And so DART registers that, and again, listening to the blockchain and changes of the loan ownership. And so we think DART is relevant beyond mortgages, so to other property assets, but then other crypto assets as well. And again, perfecting ownership. And one of the challenges in blockchain is the legal framework about if you're buying something on chain, if everything blows up, and there's bankruptcy proceedings, how are you treated? Do you actually own that asset? And so DART is a really important way to enhance perfect true ownership over the asset. Then USDF consortium, let me get into that one. So banks, excuse me, own, 70% of obviously the commercial lending, right? And they have a massive deposit base from all their customers. They're highly regulated. Banks absolutely have to be part of this transition onto blockchain. And digital money, right? Fiat, issued by a trusted issuer that is reliable, resilient. If you want to take your money out, you can get US dollars in your bank account kind of thing, are so critical to the ecosystem. And USDF was designed for regulatory feasibility. What that means is USDF can only go to KYC wallets of other USDF consortium members. This is important, right? It can't go out into the ether to, bad places, helping bad people do bad things. It basically has to be to an already KYC customer of a consortium member bank. But this is really important. And we've been doing a lot of input from a consortium basis. And these USDF is minted on Provenance, and Rob Morgan is the CEO of the consortium. He comes from the ABA, which covers 4,000 plus banks. He has deep regulatory policy and banking knowledge. He ran the ABA's Office of Innovation. And the important bit of this is you can finally get to programmable money. If you have the real financial asset on chain, the mortgage, you can have the loan repayment on chain enforced by a smart contract. If you have a private fund, you can have a capital call enforced by a smart contract. You can have dividend payouts, right, enforced by smart contracts. So you get this, you finally, as a payments girl by trade, you get this programmable money, which is really powerful and interesting. The ability, again, to have all your business customers accept funds in real time and without paying interchange. And then paying for these digital assets, right? You want to use fiat linked money. And so this is really an important piece of the equation. We're actually pivoting on USDF consortium to put it in a private zone of provenance because regulators, and I'll get into this and the challenges, I think are still getting their heads around public chains. You can mitigate the risks, you just mitigate the risks in different ways, but it's sort of, all of this is an education process because decentralized finance works quite differently to existing financial systems. So we're going to walk before we run, but we're excited about that. And there's 13 banks that have already committed to Mint, and Rob has broadened the consortium to accept members who aren't yet ready to mint, but want to be part of this advocacy and policy engagement, because banks really have to be part of the digital money equation and a critical part, in my humble opinion. So then how else do you drive adoption? Well, start where the pain is acute, start where the pain is real, right? We are not tackling public markets. Public markets are highly liquid, highly transparent. Everybody's plugged in, so it's really not, there's not a lot of juice there in terms of friction and kind of pain points. So we're starting in private asset space. Again, this is huge, right? Predicted by folks to be a $16 trillion business that's tokenized, right? Alone, up from 0.3 trillion today. And this tokenizing and then being able to offer secondary trading, et cetera, allows really a lot more assets to be accessible. This gets into accessibility. It allows the price to drop, right? Because right now the agreements are sitting in lawyers' cupboards. I own several private assets, private investments. I forget where my copy of my ownership is. It's sitting in my email somewhere. It's all over the place. I go to portals to check in my net asset value, et cetera. So this is really important, and it's across a wide range of asset classes. So Figure is focused on private market securities and private funds. We're working on private credit as an example, infrastructure assets, et cetera. So that's key. And then where we focus next to broaden adoption, I think sticking in the private theme, taking Figure's success in lending, excuse me, and from a residential side, and work on commercial real estate and CMBS and non-traded REITs, which ironically, of course, are traded some, but this is the world's largest asset class. It is highly illiquid and high barriers to entry. So we think this is a great use case. Infrastructure debt. We're working with a really interesting firm that's building out a capability. This is a $93 trillion illiquid market globally. It has a $15 trillion funding gap. This is bridges, roads, power plants. These are important public infrastructure. These are good quality assets with good returns, with low default rates. But the fact that there's a funding gap, it's really only banks that can buy these assets, and banks, can't buy that much because it puts a hole in their balance sheet in terms of the risk capital they need to hold against this. But there's a lot of other people that would buy these assets if they were more accessible. People like pension funds and insurers, where longer dated assets are really important for their asset liability book, right? They have more longer term exposures. Distressed credit, we're really excited. This is another, claims visibility. There's been some high flyer bankruptcies lately, and obviously we're entering a really tough period globally from an economic perspective. And can you put bankruptcy claims on chain? And then you offer secondary trading, distressed assets. There's a big delta between what different people think the asset is worth as it gets worked out. So that liquidity and opportunity to express that point of view is important. And then you can do some neat things with tokens that provide other financial outcomes around those claims. So we're super excited about that. A lot of people have tried to tackle receivables. This is big. And the issue here is fraud, right? Having a non-duplicate invoice, but blockchain allows you to basically have the buyer certify the invoice, right? So yes, I agree to buy $5 million worth of goods. Make sure then, therefore, that's the unique invoice, and allow the supplier to get paid earlier, accepting some kind of discount with the financing component obviously coming in. But again, just think about that assembly line, and the invoice is issued digitally on chain. It's signed from the buyer. We know it's a unique record and copy. And then you can program the money, right? As other people take on that invoice, meaning the seller gets their 95 cents on the dollar, somebody else is holding that agreement to pay. And so you can therefore, by smart contract, enforce the buyer paying the person that now owns that receivable, even if that receivable changes hands for many people. And then we're also focusing on two-sided marketplaces. I think we're working many lanes because, banks, it will take them a while. So that's the slow burn, but very important. Non-bank FIs have more room to maneuver and work on use cases. And that's where we're seeing the private funds success cases. And then two-sided marketplaces are important because they already have a network of buyers and sellers. Because if we just target the asset originator, but we don't have buyers for that asset, or vice versa, right? So really bringing on two-sided is important. And as we do this, as we build more and more asset classes on chain, you bring a more mature and interesting suite of investor base. So qualified investors that are buying these private funds, insurers and pensions that are buying these long dated assets, banks and credit unions that are buying a lot of the lending assets, et cetera. So you're really cultivating a neat mix of originators and buyers of assets that get you to this concept of a real-time everything marketplace, meaning for financial assets, again, where you're agnostic to the counterparty. I don't have to know you from Adam, and we're dealing on the street. We're dealing on, we don't have to go in a door and ask somebody to do something on our behalf. So there are other things we're working on. These are some of the major ones, though, that I would say are near term to fruition, meaning within the next year. These will definitely be very live and kicking at scale on Provenance is our view in terms of where we are in working with builders. And then let's get to the challenges, and I'll just and then we can open it up to questions. Again, I joke that my job description is selling frontier technology to traditional and conservative and regulated financial institutions that disrupts part of their business. So that's my name tag. But the reason why we're so excited, at the foundation and all of our partners, right, that are supporting, helping, building, is because this is better. Blockchain is better. It creates a better product and service. And over time, we're moving from a concept of asset management to digital asset management, right? As you get more assets natively on chain, then you can combine different assets to give investors exposures in new ways. So the product combinations will be much more facile because the underlying is more streamlined, right? It's not riding on all of these old legacy rails. But we think that ultimately, again, this concept of broadening access, improving speed, massively reducing cost to serve, and then the ability to innovate new products and services all make for a much better future. So we, from my point of view, if we fast forward 10 years, a significant part of financial services will be issued natively on chain, it will be paid for by tokenized bank deposits, and it will be running on a blockchain. I view that really, I have a lot of conviction. I could be wrong, but that is where we're going to be in 10 years' time. And what we're doing is building that bridge to that future, slat by slat, again, collaboratively, with a range of market participants to just slat by slat, we're going to get across that Death Valley or Grand Canyon, or pick your very big, big space to get across with the bridge. Some of the surround sound that has to be built. I mean, we absolutely need to see continued maturation and development of some enablers, right? We're still not there yet in terms of all the building blocks. We need improved regulatory and legal frameworks. That's really, really important. On the regulatory side, for sure, clarity for tokenized deposits. A lot of the original debate on stablecoin was like for non-bank participants, when in reality, actually, we should be enabling banks to mint money based on dollars they have in the bank account to facilitate these real-time payments. That's really important. It's also important we get comfortable with public chains. So, the private zones or permission zones, to me, are training wheels on the way to the future. They might be necessary for certain asset classes like money for banks who are extremely highly regulated. But over time, all of the ways to de-risk a public chain will be mature, and public chains really will be better. So what that means, for instance, is privacy dApps that aren't like Tornado Cash, right? That allow you to obfuscate basically bad or illicit activity, but privacy dApps, because again, this is like ultra transparency, and we are in financial services land where, money flows out of different places people don't want to see. Some CEOs don't want their cap table on chain, as an example, like that you could see that they have 17 funders basically, or 200 funders. So privacy needs to evolve. Security, I mean, there's still some, somebody quoted yesterday at an event I was speaking at, an institutional investor event, that there's like 1,000 bank heists every year, but of course those don't get publicized, but what gets publicized is all the hacks. Security is still a challenge, and particularly in the interoperability space, as we move across chains, that's a particularly weak link that needs to be, from a technology point of view, enhanced. And last and very importantly is this identity, ownership, and control. So there's still not a great ubiquitous AML KYC credentialing so that you could rely on credentialing. That's always been difficult. But again, it's basically an identity asset that could be tagged on your wallet. So who are those oracles? Who does that KYC? What are some of the standards that people will accept? That is still all under development, I would say. And then legal frameworks for asset perfection. We're really excited about DART. There's different regulatory regimes globally. So that perfecting true ownership needs continued work across jurisdictions. So that is what I had to cover, and hopefully it gives you guys a lens on maybe some of the use cases live today and the benefits. And happy to go in more detail. I wanted to make sure we left plenty of time for questions. But we'd love to collaborate. Again, this needs a lot of smart people. This is a big nut to crack, changing how financial services gets done globally, using digital money, digital assets, and blockchain. So we need all the smart brains contributing on this call around the world. And really it's asset class by asset class, use case by use case. But I think, so while we're early days, if I had to sum up where we're at, we are, for the baseball enthusiasts, in first or second inning, or for the football enthusiasts, the first 10 minutes of the match. However, we have some really clear use cases. They are not POCs. Figure was worth 3.2 billion in their Series D. Operating their business on Provenance is giving them a leg up in terms of the quality of their products with their customers and the innovation around it, the speed and ease. they've also Figure's done a lot on the other beyond blockchain on the digital front, right? So a lot of this is really combining digital wow experience that's really thoughtful and creative, and on blockchain that creates a lot of these other benefits that we talked about. And between the two of those, you just get digital wow, which is exciting. And I'm certain other folks will obviously be building similar products across different asset classes that do the same, that create digital wow for customer. And some of the benefits are like on the mortgage side, as an example, 120 basis points savings from origination, servicing, financing, and securitization. And what that means is you give the customer a lower interest rate, right? These are customer perceptible benefits of blockchain. So you can give the customer a lower interest rate, which saves them tens of thousands over the life of the loan. And the mortgage originator, can improve their net margin, right? When their gross margin is pretty good, but their net margin is pretty poor. So it's a material improvement in their net margin, as an example. And so a lot of this starts with operational efficiency in some ways, but then the benefits are much broader than that. Again, as you go down that life cycle that we talked about, that give new revenue upside, give ability to attract more customers, et cetera. So let me open it up or turn it back over to you, Diana, to run the Q&A. Reach out to us, please, if this sparked any interest or any ideas or any thoughts. And yeah, delighted to take questions.
Absolutely. Morgan, this was fantastic. Thank you so much for sharing your insights as an experienced financial technology entrepreneur with a background in traditional finance and paving a journey to really revolutionize a lot of these services that we currently use and are in need of so much innovation. So first of all, I'd like to say, how should people engage with you if they can? And how should they collaborate with you?
Absolutely, and delighted. I think our website is provenance.io. You can see, we have our block explorer, so you can see transactions live on the chain, the validators, all the assets, et cetera. So that's the window and factory floor. Join us on LinkedIn, obviously, or Twitter, if you're a Twitter fan. And obviously, we have a Discord as well. I think we're publishing a lot of materials. So we just, I've just built out the front end of the foundation. So, we have an amazing CMO, Dan Garcia. I just did a Bain podcast. Check that out. It's on institutional adoption. It's with R3. I thought I might have to arm wrestle Todd McDonald, because we have different views, but check out, it's Bain's new Deciphered podcast, just was released literally like a few days ago. That might be of interest for folks that maybe want to hear different angles on this. And yeah, reach out to me personally, McKenney at provenance.io if you want to chat also on anything. So great. Thanks for asking.
So among the audience, if you want to reach out to Morgan directly, she just gave us her email. So along the lines of collaboration, could you expand more on what is the significance of joining a consortium or partnering with other institutions? And precisely for Provenance, your involvement with the USDF consortium?
Great. Well, and it's a great question. So the consortium, what's neat about the consortium, first of all, nobody can go this thing alone. Like, finally, banks learn that too, right? You can't build everything. The world's moving too fast. Digital is disrupting every industry, and you just can't be an expert on everything. So partnering is critical. But decentralized system is like collaboration on steroids, right? So it's really a new type of participation in an ecosystem. And what the consortium, the USDF consortium value are twofold. The first is they have a reg playbook. Each bank, if they're going to be a member of the consortium and mint USDF, has to get approval from their core regulator, right? Whether that's national or state. Mm-hmm. And so there's a reg playbook of how to have that discussion. So each bank is not on their own having to answer all these questions and basically get regulatory support. The second benefit is the tech playbook, right? So there's a Figure bank-in-a-box API that banks can plug into to mint and burn. We've also worked with core providers like Jack Henry, and we've also worked with Fiserv. So Jack Henry has embedded the capability of minting and burning in their core banking platform. So again, banks don't have to code to the protocol kind of thing, right? So we're trying to make it, the consortium makes it easy for banks to participate through reg and tech support. And it's a collaborative coin, not to disparage JP Morgan coin as an example, that's only available in JP Morgan's ecosystem. And while as big as that is, it's, let's say 10% of the world, 15%, it's not 100% of the world. And what USDF is ultimately is a collaborative coin. If I'm Bank A, my customer wants to pay you, Diana, at Bank B, I'm minting USDF on demand. So it's already in your wallet. You don't buy it, right? It's opaque. The customer uses their mobile app, send money to Diana. Diana, you're a customer, KYC customer at Bank B. Bank B receives USDF and credits their customer instantly. And then the net settlement happens, let's say 2 hours later kind of thing across those banks. But the point is, it's a collaborative coin, which is actually, I think, a big leap forward. Because ultimately this has to be mainstream. It has to be the ability for banks to participate. We have to have an open platform ultimately. So hopefully that helps answer the benefit. And then Rob has broadened it out. So you used to have to commit to minting. Rob Morgan at the consortium has allowed members to join without that commitment because it's important for education on use cases, learnings, et cetera. So when that bank is ready to mint, they have a running start already, having been participated in and having their voice heard in stablecoin legislation, which is really important to get the legislation right, so that banks can mint money, basically.
Absolutely. Now, with regard to implementation, what are your thoughts with regard to user habits and really training the users to transition to form the new habits that they need to use these new products? Ideally, not much, but there will be some changes with respect to having wallets, using wallets, the interaction.
Yeah, and this is why, and I didn't mention it on the challenges, but easier user adoption tooling, right? So wallets in a decentralized land, wallets are your gateway. They are your identity verification. They hold your digital assets and they allow you to transact, right? To do something. So blockchain is the self-checkout lane of finance, right? It allows you, not only do you own your assets, which you own your assets today, it allows you to control those assets, right? Meaning do what you want with them when you want without talking to anybody. And so Wallet Connect and the concept of kind of coming to the party with your wallet is a change in user behavior. People's wallets, have Apple Pay, right? I mean, so an expanded version of wallet and wallet tech and kind of the ease of use and the ease of plugging in, your wallet to different places needs to be massively, like the UI UX still in general in decentralized finance is not great. And that needs to keep maturing. So that's where we'll get to. For USDF specifically, the good thing is the consumer has to do nothing. So they basically pay, it's the rail behind. You don't buy USDF on an exchange like you do with USDC. You don't have to, quote, keep it in your wallet. USDF is already in your wallet because it's only minted on demand out of the dollars in your bank balance. So your bank account gets debited, as you expect, and you just send money. So the rail is in the back. So that's
the practicality.
Yes, exactly. So consumers in USDF land don't have to do anything different, which is great.
Now, when you talk to banks and approach them about DeFi apps through Provenance, what's their reaction usually? Are they hesitant or are they more eager to try something new? The reason why we ask this also is probably when you look at the DeFi users, there's a big contingent of institutional and large professional players. And how has your experience been with them?
In terms of, sorry, you cut out on the beginning of the question, Diana. Say again.
Oh, when you approach banks about using DeFi, are they more hesitant or are you seeing an increasing eagerness?
Yeah, it's a great question. I think, and people also ask a related question is like crypto winter, has that changed anything in institutional adoption? And I would say generally no, because this is glacial, right? So banks already have their digital asset team. Any large bank has a pretty mature, I understand Goldman's team is 80 people, right? Citi has a big team across the businesses. So there's a recognition, I would say, at the large banks, certainly, and even these smaller banks that are part of the USDF consortium, that this thing is not going away. And there needs to be a strategy and approach of how to harness it, how to use it, what disruption does it pose to existing business, where should they lean in to amplify strengths? So they're already well and trained on assessing their, and most banks have now articulated their digital asset strategy, meaning where they're going to start. So a lot of them are starting with enabling trading of crypto assets for their customers. Some are working on custody, as an example, custody and execution. I think for us, we're focused initially on USDF with banks. That's sort of the toehold, because we believe, and the banks that are part of the consortium also really want to be part of this next gen digital economy. And then we'll explore business flows like mortgages. And so with banks, for us, we're starting mainly in the digital money space, but with each bank, they're so large, they have so many applications. So many of them are talking with us about how to buy those assets, right? When you issue a HELOC natively, digitally, you can start getting into programmatic distribution of quarterly, ABS basically, and having a warehouse line and having the payments go digitally, et cetera. So like you can really start setting up some neat automation of the securitization as an example. And so banks are focused on buying assets, I would say, and minting USDF initially, but then many of them have high net worth businesses. So they want to bring in these private asset products to their customers, right? Like to their high net worth customers as an example. So each bank is a little bit different, but all are talking. We're talking with all of them.
Excellent. Now, also when we talk about DeFi and essentially decentralized financial services that are popping up through blockchain, we're really seeing a backbone of a truly global liquidity pool and a truly global financial system that has a very interesting aspect of financial inclusion all over the world. And when you compare that to traditional finance, it's a very regulated industry. How do you see yourself, and what are your plans for either global expansion or retaining that sense of a global presence and navigating the regulatory landscape all over the world, and the fact that financial services are still siloed in the way?
Absolutely. We're focused on institutional and regulated finance, meaning that's our target market, right? So I think there's definitely a part of DeFi that is unregulated, but that's, in our view, generally speaking, unsustainable over time. Like the genie's out of the bottle, perhaps in some ways, and some stuff it's harder to rein in, perhaps. But ultimately, for safety, security, reliability, this is value. This is people's assets, their hard-won dollars, euros, whatever market they're in, their savings, their life savings, their pension kind of funds, their 401ks, all of their investments. So I think more of decentralized finance will move into a regulated context as it grows, I guess is how I would say it. And that's the only way DeFi becomes mainstream also, right? If you don't have these banks participating, that is where the customers are, that's where the deposits are, et cetera. So I think over time, there'll be like a convergence, if you think about it, of traditional finance and how they need to do everything in a highly regulated way, and kind of DeFi applications. So that's, it's a little hard to call, but ultimately the money is in TradFi. So you need to help support them, and they are highly regulated. So they have to do, blockchain is the technology. They have to understand, is it the security that they're listing? How do they meet all the requirements, et cetera? So, we're enabling regulated players to operate, but they still have to, maintain their requirements, even if they're sitting obviously on blockchain. So that's kind of how I see it. So we're so early. You remember that chart, right? And that's just private assets. But so as more and more assets come on chain, they will be more and more in regulated context, just because, again, this stuff matters to people. Like you do have to bring consumer protection, to that, and that mindset of trust ultimately, even though it's just, delivered through a distributed system. We're saying right. Blockchain sort of replaces intermediated trust with truth, right? Truth through a decentralized system, because that cost of intermediation is so high and it's prohibitively expensive ultimately, right? Having lived around the world, financial services is for people who have money today, right? But that's largely driven by a high cost to serve. So if you can bring down the cost to serve, you can, and fractionalize assets as well, you can really increase access to these wealth creation vehicles, access to credit, et cetera, distribute risk better and more efficiently so that you can originate more to a broader set of participants.
What about the impact on accounting and audit with respect to, for example, do the USDF member banks treat the stablecoin like a normal fiat for account statements or other official statements?
Yeah, it's good old fiat. So again, it doesn't have a separate line. Your bank account statement won't say, oh, you spent $10,000 and you spent 5,000 USDF. No, you spent $5,000 kind of thing, right? It just, so there's no separate line item for USDF, because just think it's the enabling, it's the rail that gets it quicker to the other side to buy the asset, to pay for something. So no, from an accounting perspective, USDF, it's the same. There's no separate line item.
And moving on to the role of security token offerings, there's a lot of reports that the market is very thin. We've seen that there's been very low levels of liquidity despite very high levels of excitement. What do you think the reason behind that is? Would it be regulation? Would it be issues with potential issuers preparing for IPO processes, missing advisors, lawyers, the ecosystem that we haven't quite fleshed out?
Yeah, it's more the latter. That's what I would say, meaning things are still very, very, very fragmented, right? We don't have these pools of liquidity, these new kind of DeFi pools. We have to work on distribution. So a lot of what we're doing, again, we're trying to grow asset types and grow in, asset buyer profiles. At the same time, we're also trying to plug into distribution, right? So, if you think about, there's like the Fidelities of the world that they excel at distribution, right? So can we improve the products on the shelf kind of idea? Can we plug into ATS aggregators that really can distribute an asset to different liquidity pools for a broader set of trading, as an example? So a lot of stuff needs to be matured on the distribution. I mean, I'm here in Zurich. I just met, with some folks here, and can you plug into different exchanges, right? There's some exchanges that are focused in digital securities, as an example. So I think fragmentation of liquidity pools will remain a challenge, and it will take some maturation for the different pipes to be knitted together in a way that the liquidity pools deepen, basically. It's a great question.
Well, excellent. I think we are out of time now. But thank you so much, Morgan, for joining us today. We really enjoyed your thoughtful and very engaging presentation, and also this Q&A on Provenance Blockchain. We look forward to learning more about Provenance Blockchain's progress, and a recording of this presentation will be circulated to all of those who registered, and it'll also be shared publicly on GBBC's YouTube channel. And thank you, everyone.
Thank you so much. Thanks, Diana. Thanks, GBBC, for having me. Really delighted, and nice to have the opportunity, and look forward to continuing discussion. This is needs lots of brains on the case. So
yeah, like you said,
thank you so much.
And collaboration are very important. So
absolutely.
Look forward to that.
Thank you so much.
Bye.
Bye.